Hello folks, this is Tony Drake from Drake & Associates with an educational economic update for November 2018. In this month's video, I'll discuss some of the major headlines that influenced markets in October. I'll also provide some insights into what these developments could mean for you as an investor. As always, please stay tuned at the end of this video for a required disclosure statement. Now, you may have heard that October is often a spooky time for the markets. Historically, it's the most volatile month in the calendar. Some of the largest crashes have occurred in October as well, including 1929 and 1987. The most significant sell-offs during the 2008 meltdown also happened in October. This October's results reflected the month's rocky reputation as the S&P 500 lost 6.9%, posting its worst monthly showing since 2011. This also led to a 1.9 trillion in losses. Similar struggles happened in other domestic indices and worldwide. The Dow gave back 5.1% and the Nasdaq dropped 9.2%, its largest monthly decline in nearly a decade. Plus, global equities had their worst performance since 2012. So what happened last month to really cause these declines? Seasonally, volatility may partly be to blame, but settling for that explanation doesn't really give you insight into what investors responded to last month. The volatility started at the beginning of the month when the Federal Reserve Chair Jerome Powell indicated that interest rates will continue to rise. However, increasing rates were not the only concern on investors' minds in October. Ongoing trade tensions and questions about U.S. corporate profits also affected sentiment. In particular, several major tech and internet companies experienced large price drops after releasing their earnings reports. These stocks can attract investors who are really chasing results, so both good and bad news can really drive large swings in their prices. Thanks to many companies' positive earnings results, however, October ended with upward momentum. By the end of October, estimates indicated that the S&P 500 companies grew 26.3% during the third quarter. In fact, investors started to buy back the technology stocks that sold earlier in the month, helping to erase at least some of the U.S. indices' losses. Markets closed the month with 2 positive days in a row. So what does that all mean? What happens next? Well, going into November, market fluctuations could continue for a while. Questions about interest rates and a global economy remain. The midterm elections could also affect investors' behavior, but the economy seems to be moving forward. The Federal Reserve recently said that we're in a remarkably positive moment. Now that's always good news. Behind last month's volatility, we also learned that the economy has had solid growth in the third quarter, and the labor market really remains strong. As always, we'll continue to focus on the economic fundamentals rather than letting dramatic headlines sway our long-term goals. Now that's it for this month's Educational Economic Update. Please visit us at wealthwisconsin.com to learn more about our upcoming workshops, and be sure to listen to our Retirement Ready radio show on AM 620 WTMJ Saturdays at 1 p.m. Once again, this is Tony Drake from Drake & Associates signing off for the month of November 2018. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your own personal financial situation, please feel free to give us a call. As always, we'd be happy to talk to you. Thanks.